Welcome back, everybody, to another episode of Main Street Money, where Wall Street meets Main Street. I'm Andrew Gay.
And I'm Zach Green.
And as always, our goal here is pretty simple. We take what's happening in the markets, the economy, and the financial world and try to translate it into something useful for everyday investors. Now, we're recording this while the markets are still open this Friday, so some of the numbers can certainly move around before the closing bell. But this has been an interesting week, to say the least. Stocks have been choppy. Technology has taken a little bit of a breather. Walmart gave us something to think about with regarding the U.S. consumer. And next week, we have two pretty big events coming our way: NVIDIA earnings and Kevin Warsh's first Jackson Hole appearance, which is a thing. It's an annual meeting where the Federal Reserve meets at Jackson Hole. But believe it or not, I don't think stocks were the most interesting market action this week. I think that honor belongs to bonds. Good old boring bonds. So long-term Treasury yields moved sharply higher. That was one of the biggest headlines this week, with the 30-year U.S. Treasury reaching levels we haven't seen since 2007. So that's almost 20 years. So today we're going to take a 1,000-foot view of what actually happened, why it matters, and what investors should actually be paying attention to. So let's jump right in. Segment 1, Wall Street hits a little summer turbulence. Let's start with the stock market. It's been a pretty remarkable run this year. Wall Street finally hit a little turbulence this week. Technology and semiconductor stocks were among the weaker areas of the market, and the Philadelphia Semiconductor Index was down roughly 5% for the week heading into today. That's notable because AI and semiconductor stocks have been such a major driver of this year's market. But I also think we need some perspective here. Markets don't go straight up. They're not linear. We talk about that on the show a lot. After a strong run, it's perfectly normal to see investors take some profits, take a breather, and reassess what they're willing to pay for stocks.
Mm-hmm. And I think that's important because a couple of bad trading days can feel a lot bigger than they actually are. If you only watch what happens Tuesday through Thursday, it can feel like the entire market story changed. But when you zoom out and look at where we've come from, we're still talking about a market that's had a very strong year.
Right. And it definitely can feel like that at times. And something we probably can't say enough. The market can have a bad day without having a bad year, or a bad month, or a bad quarter. It can have a bad week without having a bad economy. It can even have a correction without having a recession. Those are all very different things. And I know today's world, we sometimes get the stock market mixed up with the U.S. economy, or sometimes we think those are like the same thing, and they're not. They have some overlap, but they're not the same thing.
Yeah, and especially after a strong run, some volatility can actually be pretty healthy. It forces investors to reevaluate valuations. It shakes out some speculation, and sometimes it creates opportunities in parts of the market that haven't participated as much.
And that's a really good point, Zach. I think that we're beginning to see a little more selectivity from investors. They're not simply just buying anything with the letters AI attached to it anymore. They want to see earnings. They want to see cash flow. And increasingly, they want to see when all of this investment actually starts producing a return. That's going to make next week NVIDIA's earnings particularly interesting. Segment 2, the bond market sends a message. What is that message? Now let's talk about what I think is the most interesting story of the week: interest rates, also bond market. Those two things kind of go hand in hand. Long-term Treasury yields moved sharply higher earlier this week. The 30-year Treasury yield actually climbed above 5.3% at one point, reaching its highest level since 2007. The 10-year, which is on the screen there in the market dashboard, also moved back towards the upper end of its recent range. And Zach, when we start talking about Treasury yields, I know some people's eyes immediately glaze over.
Yeah, nothing says exciting podcast quite like the 30-year Treasury.
Oh, that's funny. Exactly. But this one actually does matter. And I'm going to tell you why. Because those long-term rates influence borrowing costs throughout the economy. Mortgages, business loans, corporate financing, government borrowing, and even the valuations that investors are willing to pay for stocks.
And I think there's another side that's important, especially for our clients. higher rates aren't necessarily bad news for everybody. If you're a saver or a retiree who's looking for income, today's bond market looks dramatically different than it did several years ago. And you can actually get some meaningful income from high quality fixed income investments again.
And that's a really important discussion and a really important point. Higher interest rates can create pressure in one part of the financial system while creating opportunity somewhere else. Like you were saying, high interest rates might be tough for lenders, or borrowers, but it's good for savers. Mm-hmm. That's why we try not to label something simply as good or bad. I think most of us would agree that most things in life we come to find out are not that black and white, right? The question is good or bad for whom? Did you catch that? My grammar's on point today. For whom? And good or bad for what part of your financial plan? So segment 3, the economy is still sending mixed, but mostly healthy signals. We also received some interesting economic data this week. The initial unemployment claims came in about 206,000. That's a still relatively low number and suggests we aren't seeing a major deterioration in the labor market. Then this morning we got a fresh business activity numbers. The services side of the economy actually accelerated pretty significantly. The preliminary services PMI came in around 56.8. That's the strongest reading in nearly 2 years. Remember, generally anything above 50 indicates expansion. That's how you look at that metric. Expansion in the economy, right? So growth in the economy. Manufacturing was a little softer. It came in around 53.2, but that's still above the 50 mark, which means it's technically an expansive territory.
And that's another one of those situations where the economy isn't giving us one perfectly clean signal. Manufacturing slowed slightly. Services accelerated. Employment remains pretty healthy. Consumers are becoming more selective. But overall, economic activity is still expanding.
That's right. In fact, the latest PMI data suggests that the economy may be tracking around 3% annualized growth rate here in the third quarter. That's certainly not an economy that looks like it's falling off a cliff. But we did get another interesting signal from retailers this week. You ready for it? Walmart reported its slowest comparable sales growth in several years, and the stock sold off sharply. At the same time, Home Depot beat expectations, and Target actually reported a pretty solid quarter and raised its outlook. So what would you make of that, Zach?
To me, it says the consumer isn't disappearing. They're becoming more selective. People are still spending money, but they're paying closer attention to where they're spending it. And with energy costs elevated and borrowing costs higher, households are having to prioritize a little more than they were a couple of years ago.
I think that pretty much sums it up. And that's an important distinction. A selective consumer isn't necessarily a weak consumer. Did we get that? A selective consumer isn't necessarily a weak consumer, but it is something that we're watching. Segment 4, the Fed, oil, and what comes next. Of course, if we can't talk about higher Treasury yields without talking about the Federal Reserve. The minutes from the Fed's July meeting came out this week, and they showed a pretty divided committee. The Fed that's kind of been the talk of the town. I feel like we've heard that multiple times this week. The Fed ultimately voted 9-3 to leave rates unchanged at 3.5 to 3.75%. So there were 3 dissents. And so 3 people on the Fed's board that voted against or voted to hike rates, right? So that's the biggest divergence there that we've seen in quite some time. But the minutes showed that concern about inflation runs deeper than just those 3 dissenters. Several policymakers were prepared to support a rate increase, and many indicated another hike could eventually be necessary if inflation doesn't chill out and keep moving towards the Fed's 2% target, because it hasn't. We had that, we had the spike this year in oil prices, which brought back inflation concerns to the market when we thought we were kind of on this moderating path towards 2%.
Yeah. And I think that's pretty interesting because not very long ago, like you said, the conversation was almost entirely about rate cuts. It wasn't a matter of if, it was a matter of when. Now we're debating whether the next move might actually be another hike after this one.
Yeah, surprise. And geopolitical uncertainty isn't making that decision any easier. Oil prices remain elevated as the conflict involving Iran continues to affect global energy markets.
Mm-hmm.
If energy prices remain elevated, that can feed back into inflation and make the Fed's job even more complicated. And we've talked about that on here previously. And next week, Kevin Warsh heads to Jackson Hole for his first time and first appearance there as Fed chairman. That's going to be very closely watched.
Especially because investors are still trying to figure out what a Warsh Fed kind of looks like. We've gotten some clues, but Jackson Hole gives him a much bigger stage to explain how he's thinking about inflation, interest rates, and the economy.
And I think next week could be fascinating because we'll essentially have two major questions being answered at almost the same time. From NVIDIA, is the AI investment boom still delivering? And from Kevin Warsh, where is monetary policy headed next week? Those two are pretty big questions for this market right now. Segment 5, our financial planning corner. Your time horizon should determine your risk. I'm going to say that again. Your time horizon should determine your risk. Let's finish with our financial planning quarter. This week's bond market story actually gives us a perfect planning lesson. I want to talk about time horizon. One of the mistakes investors sometimes make is thinking about their portfolio, their entire portfolio, as one big pile of money. But realistically, money that you need next year should probably be invested differently than money that you won't need for 20 years. And more than often than not, we're talking about, when we're saying a longer time horizon, we're talking about accumulators like us that are saving for retirement decades out, right?
Yeah. But this is especially important for retirees. If someone's retiring tomorrow, the money they're going to use for their living expenses over the next couple of years probably shouldn't carry the same risk as money that I'm not going to touch until I'm 65 or 70. I have that longer time horizon, so I have more time to ride these ebbs and flows of the market.
That's right. And today's interest rate environment makes that conversation particularly interesting. Several years ago, investors essentially had two choices: accept almost no return for safer investments. Think about what kind of interest rate or what kind of yield you were getting on CDs and stuff that was like FDIC insured, right? Like there was just no meat on the bone, right? Take more risk, take more market risk, right? So either you go the safe route, you get almost like no return for not taking any risk, or you just got to full on take market risk, right? Today that has changed. As a matter of fact, before we opened up the recording for this episode, you, me, and Gilbert were talking to a wholesaler about this exact thing, about how the interest rate environment being different, basically post-COVID, right, has created all kinds of new opportunities and just a different backdrop for financial markets and investors, and in this case, retirees. So with Treasury yields and other high quality fixed income yields at levels that we haven't seen in years, investors can potentially earn meaningful income from the more conservative side of a portfolio again.
Mm-hmm. And I think that's kind of where asset allocation becomes much more important than simply asking, should I be in the market, or should I be invested? Should I not? That's usually the wrong question. A better question is, how much of my money needs to be exposed to market risk based on when I'm actually going to need it?
Yes, that's exactly right, which is where time horizon comes into the equation. If you're 45 and retirement is 20 years away, this week's movement in Treasury yields probably doesn't change your life very much. But if you're 68 and you're withdrawing money every month to pay your bills, suddenly the income available from bonds becomes much more relevant. That's why we talk so much about matching your investments with your goals. And in this case, time horizon. Some money may be there for short-term needs. Some may be there to provide stability and income. And some may need to continue to grow for another 20 or 30 years.
And that's also why two people with exactly the same amount of money can have completely different portfolios. The right allocation isn't determined by your account balance. It's determined by your goals, your income needs, your risk tolerance, your time horizon, and we could probably add in a couple more factors there.
That's right. And I couldn't agree more. And that's probably the planning takeaway from this week. Don't change your risk level because Treasury yields went up this week. Don't change it because technology stocks went down. And don't change it because somebody on television thinks the market isn't going higher or lower. Your financial plan should determine your investment strategy, not this week's headlines. I'm going to say that one more time. Your financial plan should determine your investment strategy, not this week's headlines. So the big takeaway this week, let's wrap everything up. This was a really interesting week. Stocks hit some turbulence. Long-term Treasury yields reached levels we haven't seen in nearly 2 decades. Retail earnings showed us a consumer who's still spending, but becoming a little more selective. The latest economic data tells us that the economy is still expanding and the Federal Reserve continues wrestling with inflation.
And next week looks far from boring. We've got NVIDIA earnings. That's a big one. And Kevin Warsh at Jackson Hole. That's going to be another big one. So I have a feeling we'll have plenty to talk about and a lot more headlines.
Yeah, and I think that's safe to say. But if there's one thing I want people to remember about this week, it's this. Markets don't have to move higher every week for your financial plan to be working. Sometimes stocks lead, sometimes bonds become more attractive. Sometimes one sector struggles while another performs well. That's the entire reason we build diversified portfolios and a financial plan built around discipline in the first place.
And the goal isn't to correctly predict which asset class wins next week or which sector is going to be the best this year. It's to have a plan where you don't need to do all that stuff. It's all baked in.
And that's a pretty good place to end today's episode. Thank you all for joining us for another episode of Main Street Money. We're Texas Hill Country Advisors. You can find us online at texashillcountryadvisors.com. Be sure to follow us Main Street Money on Facebook, LinkedIn, and YouTube, and Spotify. Zach, thanks for joining me as always.
Thank you. It was a pleasure.
Securities and investment advisory services offered through LPL, registered investment advisor, member FINRA SIPC. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.